Welcome to the deep dive. We take complex source material, think SEC filings, analyst reports, all that dense stuff, and we distill it down for you.
Giving you that strategic edge.
Exactly. And today, our mission is really about corporate transformation. We're diving deep into Plains All-American Pipeline, LP. That's PAA.
A major master limited partnership, an MLP, in the energy sector.
Right, a big name in midstream. And they are right in the middle of this huge strategic overhaul, shedding billions in assets to, well, refocus their whole future.
That's absolutely right. Our sources are pretty clear. PA is at a, quote, pivotal juncture. So for you listening, our goal here is clarity.
We need to unpack this aggressive restructuring plan they've got.
Yeah, understand why they're selling off their, very extensive natural gas liquids business. And we also need to really get into the weeds of the MLP structure itself.
Which is, let's be honest, often pretty complex.
It really is. It defines PA as an investment vehicle. And crucially, we have to map out the risks, especially the long-term ones in this, well, mature midstream market.
So we're trying to figure out if this big pivot is, smart move or maybe something driven by necessity.
The core question really is, can this strategy, becoming a leaner, pure-play crude oil infrastructure provider, can that actually justify the high distribution yield they're offering right now?
And maybe the even bigger question, can this focus mitigate that severe long-term risk from the whole global energy transition and the massive change they're going through?
It is. Let's start with the background, the legacy. To really get the scale of this pivot, you have to understand where PAA came from.
Okay.
For decades, they were, a pretty diversified midstream company, handling both crude oil and natural gas liquids, NGLs. Big footprint, operationally and geographically.
But that diversification brought complexity, right? And maybe more importantly, earnings volatility.
Exactly. Volatility is kind of the enemy when you're talking about income investments like this. So the big strategic move to cut out that volatility came this past year.
The NGL divestiture.
Yeah.
Selling pretty much that entire business line to Kiera Corp.
That's the one. And it's a huge number. We're talking about roughly $3.75 billion US dollars.
Which is what, over 5 billion Canadian?
5.15 billion Canadian, yeah. This isn't just tweaking things, it's a major reshaping of the company. Expected to close, I think, Q1 2026.
That's what the sources suggest. So the analysts see this as deliberate.
Oh, yeah. Consensus is clear. It's a conscious simplification. Streamline operations, simplify the financials, and crucially, cut down on that earnings volatility tied to the NGL segment.
Let's talk about what they actually sold. It wasn't just spare parts, was it?
Not at all. The NGL segment was a whole integrated business, processing plants, fractionation facilities like the big one in Bushton storage caverns, gathering systems, the whole chain, really.
From the wellhead to the refined NGL products like propane and butane.
Precisely. And by selling that whole chain, they get rid of the exposure to those, well, specialized and often volatile NGL markets, which means now we need to focus on what's left, the post-divestiture PAA.
Which is all about crude oil.
Entirely focused on the crude oil segment.
So where's that focus geographically? Where are they doubling down?
Okay, so they still operate a massive network, something like 18,370 miles of active pipelines. But the key takeaway for you, the listener, is the geography.
It's all about the Permian Basin, right?
Unequivocally, that's their strategic and financial center of gravity. It's not just a focus, it's pretty much the core economic engine for the whole partnership now.
And that concentration, that's their strategic advantage, their moat, owning the key crude transport routes out of there.
Absolutely. We're talking major long-haul arteries, pipelines like Cactus II and Cactus II, Basin, Sunrise. These are the big ones connecting the Permian.
To places like Cushing, Oklahoma, the big storage hub.
Right. And critically to the U.S. Gulf Coast for export markets mainly.
And it's not just the big pipes, right? They have the gathering systems, too.
Yes, that's a key part. The gathering systems, the smaller pipes collecting oil right from the wellhead, are also heavily concentrated in the Permian.
And that Permian concentration drives how much of their cash flow?
Roughly half of PAA's total cash flow comes from that Permian footprint. It's huge.
Okay, so let's shift to the money. The new simplified revenue model. The goal is stability over that volatility they just sold. How does this pure play crude structure achieve that?
It's fundamentally about the fee-based model. The vast majority of their earnings now come from stable, long-term contracts.
Like a toll road, essentially.
Pretty much. They get paid for transportation and storage services. So revenue depends almost entirely on throughput volume, how many barrels they move per day.
Which insulates them from the day-to-day swings in crude oil prices themselves.
Largely, yes. That insulation is what midstream operators aim for, but this specific sale really maximizes that de-risking. Remember, the NGL segment's profits were tied to things like
Those frac spreads you mentioned earlier.
exactly, fractionation spreads. Let's unpack that quickly. A frac spread is basically the difference between the value of raw NGLs, like straight from the gas plant, and the value of the individual purity products, ethane, propane, butane, after they're separated or fractionated.
And that spread can jump around a lot depending on petrochemical demand, gas prices.
Wildly. So that introduced significant margin risk. And then there was the supply and logistics, or S&L segment.
That exposed them to basis differentials. What's that exactly?
Basis differential is the price difference for the same barrel of crude oil between two different locations, say Midland in the Permian versus the benchmark hub at Cushing, Oklahoma.
Okay.
The S&L business made money by, well, opportunistically buying crude where it was cheaper, maybe a wide basis discount in Midland, and shipping it to sell where it was more expensive, like the Gulf Coast, where the basis might be narrower.
So more like trading activity.
Essentially, yes. It required active trading, risk management, made those earnings inherently less predictable, more volatile. The NGL sale minimizes almost all of that margin-based activity.
Tightening the focus purely onto those predictable pipeline tariffs makes the cash flow profile much clearer.
Much clearer for investors, for analysts, for everyone.
So the main indirect risk left is just volume then. If oil prices stay low for a really long time.
Right. Low prices don't hit the tariff per barrel they charge. But if prices stay low enough for long enough to really discourage drilling in the Permian.
Then eventually volumes flowing through their pipes could decrease.
Exactly. That dependence on sustained Permian drilling activity, that's the core vulnerability now for this pure play model.
Okay, makes sense. Now, before we get into the financials, we absolutely have to tackle the MLP structure itself.
Yes. If you're thinking about PAA as an investment, understanding the master limited partnership structure isn't optional. It's fundamental. It changes everything.
And for listeners maybe more used to standard stock, C-Corp, this is where things get, well, different.
Very different. PAA is a pass-through entity. That's the big advantage, theoretically. It pays no U.S. federal or state corporate income tax itself.
So the profits, losses, cash flow, it all passes directly through to the unit holders.
Correct. The idea is without that corporate tax layer, there's more cash available to distribute.
But the trade-off is complexity for the unit holder, specifically the tax reporting, instead of a simple 1099 DIV form.
Yeah. You get the infamous Schedule K-1.
Right. Talk about the K-1. Why is it such a big deal?
Well, it's notoriously complex. It itemizes your specific proportional share of everything the partnership did that year: income, deductions, credits, losses.
And it often arrives late.
Often later than standard 1099s, yeah.
Yeah.
Which can delay your own tax filing. And because PAA operates in many states.
The state filing issue.
Exactly. Receiving a K-1 from PAA might mean you, the individual unit holder, suddenly have an obligation to file non-resident state income tax returns in states where PAA operates, even if you've never set foot there.
That could be a real surprise and potentially expensive if you need tax help.
It definitely increases tax prep costs for many investors. But let's talk about the upside of the structure, the tax deferral advantage. The return of capital.
Okay, how does that work?
This is sort of the financial magic of MLPs. A large portion of the cash distributions you receive from PAA is often classified as return of capital for tax purposes.
Why is that?
Because the partnership takes large non-cash deductions against its income. Think depreciation on all those billions of dollars worth of pipelines and facilities. These are huge, long-lived assets.
So those depreciation charges reduce the partnership's taxable income, even though the cash flow is still strong.
Precisely. Which means the cash distribution you receive isn't counted as taxable income in the year you get it.
Instead,
it reduces your cost basis in the PAA units you own. So say you bought units at $15. You receive $1.50 in distributions classified as return of capital over a year. Your cost basis is now reduced to $13.50.
so the tax isn't eliminated, it's deferred.
Exactly. You defer the tax liability until you eventually sell your units. And you'd only owe capital gains tax then if your sale price is above your reduced cost basis. It allows for tax-deferred compounding over potentially many years.
Sounds great, but now the big warning label.
Yeah.
Especially for people who like to hold income investments in retirement accounts like IRAs or 401k.
Yes, this is critical. The unrelated business taxable income, or UBTI, caveat.
UBTI, explain that.
So MLPs can sometimes generate income that isn't considered purely passive, like from transportation tariffs, maybe from some ancillary services, or historically from activities like that S&L segment we discussed. That income can be classified as UBTI.
And why does that matter inside an IRA?
Because if the PAA units held inside your tax advantage account, your IRA, your 401k, generate more than $1,000 of UBTI in a single tax year.
Only $1,000.
Yes, if it crosses that $1,000 threshold, it can trigger a federal tax liability inside what's supposed to be a tax-sheltered account.
How does that work? Does the IRA owner pay the tax?
It's even more complicated. The custodian of the IRA, your brokerage firm, might be required to file a separate tax return for the IRA itself. That's IRS Form 990-T, the exempt organization business income tax return.
Wow. It sounds like a major headache.
It's a huge administrative burden, highly unusual for retail investors, and it basically defeats the purpose of having the investment in a tax-advantaged account in the first place.
So the bottom line is?
The bottom line, and pretty much all financial advisors agree on this, is that it's generally considered suboptimal or even problematic to hold individual MLP units like PAA directly inside an IRA or 401k.
So this structure really dictates where you should hold the investment in your overall portfolio. It's fundamentally different from a regular dividend stock or an ETF in that regard.
Absolutely. It's a structural consideration you have to make up front.
Okay, that's a really important clarification on the MLP structure.
Yeah.
Let's pivot now to PAA's internal financial health. Management's been very focused here lately, right? Especially on the balance sheet.
Massively focused. You have to remember, they went through a tough period, but they executed this multi-year deleveraging plan pretty successfully.
Bringing that key leverage ratio down, net debt to adjusted EBITDA.
Exactly. They got it down from a pretty high 4.5 times back in 2021, which was stretching things, down to a much healthier 3.3 times as of mid-Q2 2025.
And what's their target range for that metric?
Their stated target is 3.25x to 3.75x, so 3.3x puts them comfortably inside that range. And crucially, this helped them maintain their investment-grade credit ratings.
Okay.
BBB from S&P and Bad 2 from Moody's. Investment grade is key for keeping borrowing costs manageable.
And they weren't just paying down debt, they were actively managing upcoming maturities too.
Yes, very proactively. Just recently, in September 2025, they priced a $1.25 billion offering of new senior notes.
Why did they do that?
It was smart timing. They used the proceeds primarily to refinance some existing notes that were coming due very soon, specifically their 4.65% notes due in October 2025.
So pushing out that debt maturity wall gives them breathing room.
Exactly. Demonstrates good financial stewardship to the debt markets, keeps things smooth.
And all this balance sheet repair work, this financial strengthening, it directly supports the income story, right? The distribution to unit holders.
Absolutely. They've managed to reestablish a track record of distribution growth after having to cut it previously during tougher times.
What's the current annualized rate?
For 2025, they raised it to $1.52 per unit, which, given the unit price recently, translates to a pretty eye-catching yield, around 9.2%.
That's a high yield, but is it safe? What about the coverage?
That's the critical question with any high yield. And here, the story is strong. Management guided for a distribution coverage ratio of 175% for the full year 2025.
Okay, unpack 175% coverage. What does that actually mean?
It means for every $1 they're paying out in distributions, they are generating $1.75 in distributable cash flow.
So they're retaining a lot of cash after paying the distribution.
And a huge amount. It's a massive safety cushion. Many other MLPs operate with coverage closer to, say, 1.2 or 1.3 times. PAA is intentionally keeping it much higher right now.
Why so high? What are they doing with that retained cash?
Primarily using it to fund growth internally and continue strengthening the balance sheet without needing to issue new equity or take on too much debt.
And what's the plan for future distribution growth? Are they going to keep coverage that high forever?
No, they've signaled a clear path. Management's aiming for steady annual distribution growth of about $0.15 per unit per year.
Okay.
And they plan to continue that pace until the coverage ratio gradually comes down or normalizes to around 160%.
Which is still very conservative.
Still very strong, yes. It signals a commitment to both a safe and growing distribution which is attractive for income investors.
This all fits into their capital allocation plan, right? They have clear priorities.
Yes, they laid out a disciplined 5-point capital allocation framework. It's very clear. Number 1 priority is the balance sheet maintaining that target leverage. Number 2 is funding sustaining capital expenditures, just keeping the existing assets running safely.
Okay.
Number 3 is funding the secure and growing common unit distribution we just talked about, only after those first 3 are fully covered.
Then they look at growth and buybacks.
Exactly. Priority 4 is funding growth capital, and priority 5 is returning any excess capital to unit holders, likely through unit buybacks, both common and potentially preferred units.
So let's talk about that growth engine. How has it changed with this new strategy?
It's fundamentally shifted. The era of massive multi-billion-dollar greenfield pipeline projects, building entirely new systems from scratch, that seems to be largely over for PAA and for much of the industry.
Why is that? Too expensive? Too difficult to permit?
Both. Plus, the market wants capital discipline now, so the focus has shifted to smaller, accretive bolt-on acquisitions.
Bolt-ons, meaning things that easily connect to their existing system.
Precisely. Buying assets or stakes in assets that fit geographically and operationally with what they already own, generating immediate synergies and cash flow. And they're targeting pretty high returns on these.
What kind of returns?
Management has stated they're targeting returns of 13% to 15% or even higher on these bolt-on deals.
Have they been active here recently?
Yes, quite active. In the first half of 2025 alone, they spent around $800 million on 5 separate bolt-on transactions.
Any examples?
A good example is they acquired an additional 20% interest in the BridgeTex pipeline, which is a key pipe moving crude out of the Permian. That bumped their ownership up to 40%.
So consolidating ownership in key existing infrastructure.
Exactly. And then there was the bigger move announced more recently in September 2025.
The EPIC crude deal.
Yes, acquiring a 55% non-operated interest in EPIC Crude Holdings, LP, another major pipeline system providing that critical Permian to Gulf Coast connectivity.
So doubling down on that Permian export route.
It fits the strategy perfectly. This is the shrink to grow strategy in action. Sell the NGLs, focus the footprint, then selectively acquire assets within that focused crude oil space.
Which brings us back to the NGL sale proceeds, that roughly $3.0 billion net cash they expect to receive after the deal closes.
Yeah, how they deploy that capital is probably the single biggest execution point the market is watching over the next year or so.
What are the stated priorities for that $3 billion?
It lines up with their framework. Priority 1 is more of those accretive bolt-on M&A deals in the crude space. Priority 2 is potentially repurchasing some of their higher-cost preferred units. And Priority 3 is opportunistic common unit buybacks if the price looks attractive.
So there's pressure to deploy that cash effectively. They can't just let it sit there.
Right. If that cash sits on the balance sheet earning very little, that's cash drag, it hurts overall returns. But they also can't rush and overpay for assets.
It's a balancing act.
A critical one. But if they execute well, they have the chance to really solidify their position as a dominant, pure-play, Permian-focused infrastructure provider.
Okay, let's zoom out now. Talk about the broader industry dynamics PAA is operating within.
The whole North American midstream sector is, well, mature. It's consolidating. PAA's move reflects the wider trend.
Which is?
Less focus on speculative large-scale growth projects, more emphasis on capital discipline, maximizing free cash flow from the assets you already have, and returning that cash to shareholders.
And part of that dynamic is the difficulty of building new stuff, right? The regulatory moat.
That's a huge factor. Getting permits for major new long-haul pipelines, especially crossing state lines, has become incredibly difficult. Environmental opposition, legal challenges. It's a tough road.
Which makes the pipelines already in the ground
More valuable. PAA's existing in-place infrastructure, especially in the Permian, represents a significant economic moat. It's very hard, maybe impossible, to replicate that network today.
And the regulatory environment isn't getting any easier.
Doesn't seem like it. We saw, for instance, the Bipartisan Pipeline Safety Act of 2025 moving forward late last year. It aims to reauthorize the Pipeline and Hazardous Materials Safety Administration, PHMSA, and potentially increase penalties for safety violations.
So operating safely and efficiently is paramount.
More than ever. It's a core competitive factor now.
Okay, but PAA's success, even with that moat, still hinges entirely on the Permian, right? On that engine continuing to run strong.
Absolutely. And the forecasts for U.S. crude production are actually pretty stable, at least for the near term. Expected to plateau around a high level, maybe 13.5 million barrels per day through 2026. That stability is good for PAA's volumes.
And you mentioned the Permian's dominance earlier. There was a pretty staggering statistic in the source material.
Yeah, it's incredible. Something like 93% of all the growth in U.S. crude oil production between 2020 and 2024 came from just 10 counties within the Permian Basin.
Wow. 10 counties driving almost all the national growth.
It just underscores why, if you're in the crude pipeline business, you have to be heavily concentrated there. And PAA certainly is.
Why is the Permian so resilient, though? What if oil prices drop significantly?
It really comes down to production economics. The Permian is one of the lowest cost major oil basins in the world.
What are the break-in prices like?
Estimates vary, but the average operating break-even price for producers there is thought to be somewhere in the range of $33 to $35 per barrel.
That's very low.
Extremely low. It means production can remain economic and drilling can continue, even if global oil prices weaken significantly prices that might shut down production in higher cost areas. That low cost provides a crucial volume buffer for PAA's pipelines.
Okay, Permian is key, it's resilient. But let's talk competition. PAA isn't alone there. Who are the main rivals?
The big ones primarily are the larger, more diversified MLPs, Enterprise Products Partners, that's EPD, and Energy Transfer, ET.
And there's a big difference in scale, isn't
There
there?
are a huge difference. PA's market cap is around, $11.6 billion currently?
Something like that.
And EPD.
EPD is a giant, roughly $67.6 billion market cap. Energy Transfer is also significantly larger than PAA.
Does that scale translate into better efficiency or profitability?
Often, yes. And that's been a point of comparison, sometimes a critique for PAA. When you look at metrics like net profit margin,
What are the numbers?
well, based on recent data, PAA's net margin was around 1.54%.
Yeah.
EPD, by contrast, was closer to 10.71%. Wow, that's a massive difference. 1.5% versus almost 11%. Why such a gap? Is PAA just less efficient?
It's complicated. APSA benefits from enormous scale, much deeper integration across the whole energy value chain. They're into petrochemicals, NGLs, natural gas, refining connections, things. PAA largely isn't, especially after the NGL sale. EPD also historically had more sophisticated trading and optimization around their assets.
So PAA's lower margin reflects its simpler, more focused pipeline tariff business model.
Largely, yes. It's more of a utility-like margin profile now. The bull case for PAA argues that as the market recognizes the stability and simplicity of this pure-play crude model, that valuation gap should narrow, at least relative to the transportation segments of peers like EPD.
But it's still an open question whether they can really bridge that efficiency gap.
It's definitely something the market watches closely. Can this simplified structure lead to improving returns and a higher valuation multiple over time?
Okay. One risk area you mentioned they did address successfully was contract renewals, right? Avoiding a potential revenue cliff.
Yes, that was important. There was concern a few years ago about major long-haul contracts in the Permian potentially expiring around the same time.
What did they do?
Management was very proactive. They went out and successfully renegotiated and extended contracts across their key Permian long-haul systems.
What's the average duration look like now?
They managed to lengthen the weighted average remaining contract life on that portfolio to approximately 5 years. So pushing significant maturities out through about 2028.
That provides a lot more visibility and certainty on revenues.
Definitely. It significantly eased those revenue cliff concerns for the medium term.
Okay, but we should probably mention customer concentration too.
Sure.
Serving lots of producers, but is anyone dominant?
That's another risk factor. While PAA has a broad customer base, one analysis highlighted that a single counterparty, ExxonMobil, accounted for roughly 30% of PAA's total revenue in a recent period.
30% from one customer.
It's a substantial concentration. Now, ExxonMobil is obviously a very strong investment-grade counterparty, which mitigates the risk somewhat.
But still, relying that heavily on one company introduces risk if Exxon were to ever significantly change its Permian strategy or volumes.
It's a factor to be aware of, absolutely. Which leads us, really, to the biggest, most profound risk overshadowing everything long-term.
The energy transition.
The energy transition. This is the elephant in the room for all fossil fuel infrastructure assets. It creates fundamental, unquantifiable uncertainty about the ultimate long-term value, the terminal value of these pipelines that are built to last for decades.
And the forecasts for when oil demand might actually peak are all over the place, aren't they?
Completely. You have some forecasters, like Wood Mackenzie, projecting peak global oil demand demand, maybe in the early 2030s.
Which implies maybe another 10, 15 years of strong utilization for assets like PAAs.
Potentially. But then you have others, like the International Energy Agency, the IEA, forecasting a much sharper slowdown in demand growth, starting almost immediately, projecting growth falling to just 700,000 barrels per day in 2025 and 2026.
That paints a much quicker path towards a potential peak in decline.
It does. And this wide range of forecasts creates a huge strategic challenge. How do you plan and invest when the long-term demand picture is so uncertain?
So, is the industry's response, including PA's pivot, basically a reaction to this uncertainty?
Very much so. The clear mandate across the midstream sector now seems to be stop betting the farm on massive, long-lived new projects tied only to fossil fuels. Instead, optimize the assets you have, maximize the free cash flow now, and return as much of that cash to investors as possible.
PAA's strategy simplify, focus on crude, generate strong cash flow, pay a high distribution, fits that mold perfectly.
It's an investment in near-term cash generation and perhaps long-term optionality.
What is that optionality, though? If oil demand does start declining significantly, what happens to all those miles of steel pipe in the ground? Are they just stranded?
That's the multi-billion-dollar question, isn't it? The hope, the optionality lies in repurposing.
Repurposing pipelines for what?
Two main areas are being actively explored across the industry. First, carbon capture, utilization, and storage, CCUS. Could existing pipelines be converted to transport captured carbon dioxide, CO2, from industrial sources to locations where it can be permanently stored underground?
If the regulations and economics work out.
Big ifs, but potentially huge. Second, hydrogen transport. Hydrogen is seen as a potential clean fuel for the future. Could some pipelines, perhaps with modifications, be used to transport hydrogen?
That's technically challenging too, right? Hydrogen is trickier than natural gas or oil.
Very challenging. Material compatibility issues and brittlement risks. But it's being studied intensely. PAA's ultimate terminal value, decades from now, might depend heavily on whether their assets can be viably converted for these lower carbon uses.
Okay, let's try to wrap this all up. Summarize the investment thesis here. What really needs to go right for PAA? The bull case.
Okay, the bull case rests on a few key pillars. First, successful execution. They must close that NGL sale smoothly and, crucially, redeploy that $3 billion in net proceeds wisely.
Meaning into high-return, accretive crude oil bolt-ons without overpaying.
Exactly. Second, the Permian has to remain resilient. They need continued high utilization of those core assets, ensuring strong throughput volumes to support the fee-based revenue model.
And third,
the market needs to reward the strategy. The hope is that investors will appreciate the simplified, pure-play crude model and start valuing PAA more highly, closing some of that valuation gap compared to peers like EPD.
all right, now the bear case. What could go wrong and derail this?
The most immediate macro threat is a sharp, sustained drop in oil prices, something severe enough to really curtail Permian drilling and significantly reduce pipeline volumes.
That hits their core revenue driver.
Right. Then there's execution risk on the M&A front, making poor acquisition choices, paying too much for assets, or even just failing to deploy that NGL cash efficiently. That cash drag we talked about could really hurt returns.
And the long-term shadow.
The long-term threat is always an accelerated energy transition. If global oil demand peaks and declines faster than expected, and if those repurposing options like CCUS or hydrogen don't pan out economically or technically, then you face the risk of stranded assets much sooner than anticipated.
So listening to all this, it really sounds like the PAA story boils down to a difference in time horizon.
I think that's a very accurate way to put it. The investment outlook for the short to medium term, say the next 1 to 5 years, looks pretty strong.
Supported by that repaired balance sheet, the very high distribution coverage at 175%, the clear path for distribution growth, and disciplined M&A.
Exactly. PAA is essentially paying you a high, well-covered yield to wait and see how the strategy plays out in the near term.
But the long term, 10 years plus.
That's where the clouds roll in. The long-term outlook is fundamentally obscured by that big, unanswerable question about the ultimate trajectory of global oil demand that high-yield PAA offers. You could argue it's the market demanding compensation for accepting that deep, structural, long-term uncertainty.
We talked about PAA's valuation seeming discounted compared to peers based on cash flow multiples.
Right. But let's layer in the idea of replacement cost. Think about the immense hurdles we discussed the capital needed, the regulatory nightmare of permitting, the environmental opposition.
It would be almost impossible to build PAA's integrated Permian network from scratch today.
Exceptionally difficult and costly, certainly. The strategic replacement cost of those existing in-place assets is incredibly high.
Which leads us to our final provocative thought for you, the listener, to consider as PAA navigates this huge transformation.
Is the market, with its current valuation of PAA, properly appreciating the scarcity value of this irreplaceable in-place infrastructure? Or is that attractive 9% plus distribution yield really just masking a deep discount on assets that, while essential today, might carry an unknown and potentially closer than expected expiration date?
A fundamental question facing energy infrastructure investors today.
Indeed it is.
That concludes this deep dive into Plains All-American Pipeline's strategic overhaul. Thanks for joining us.